Hi everybody, welcome to another YouTube video. Today's video though, is going to be special. I'm going to show you how you can get an 88% income tax rate. Now, before you realize it and you're thinking, Matt, you're full of it, the tax brackets don't go that high, stay with me. Watch the whole video and watch me walk through the math on how this works. Before I go any further, if you're getting good value out of my content, there are three things. I'm just asking three things to do. Number one, I want you to like this video. Number two, subscribe to my channel. Number three, tell your friends. And if you really like me, you'll subscribe to my email list. Also follow me on Instagram and Twitter for more great content. So without further ado, let me explain what is going on. So we're going to use these facts to illustrate the case here. And I'm going to start with adjusted gross income. Now, adjusted gross income is your income before certain deductions. So this is the income on your tax return before your standard deduction gets taken off and some of the other deductions. This number is very, very, very important in the tax code. So you'll want to really pay attention to it. And in this example, we're going to assume that we're right at $150,000. We're also going to assume married with 2 kids. The kids are over 6 years old, but they're not 17 yet, so maybe they're like 10, 12, whatever. And they did not receive the stimulus in March 2021. Let's say 2020 was a great year for them. They filed their return. They did not, and they were not eligible for that. And for those of you that don't remember, that was the stimulus that was passed that you got $1,400 per person. So they could have gotten $5,600 because a family of 4. The question I have is they come to you and you're the CPA and they want to sell $10,000 of stock and they're willing to pay the tax on it. But the question is how much more in taxes are they going to pay? And this is where we have to do our due diligence. And we're going to walk through the math right now. All right, so we're going to answer this question. So I just took a few minutes and cleaned my board up. So the question is what would the increase in taxes be for that family of 4 if they go from 150 to 160 in adjusted gross income, 160,000, because they sold their $10,000 worth of stock? And I'm assuming that that's $10,000 of gain. I should have specified that they already had the basis in there, so it's $10,000 above their cost basis. So let's break this down, and it's short-term capital gain too. So we're just going to keep it simple. So when you go from 150, and I'm going to use K for 1,000 to 160. You have $10,000 times, sorry, my head's in the way. Right. So you're in the 22% tax bracket, okay? And you're going from 150 to 160, going from 150 to 160 here. So that's $10,000 times 22%. $2,200. So you think, okay, great. That's what I think the answer is. You're good try, but you're missing a couple of components. And the next component that you're missing are credit phase outs. Now, what do these mean? Well, in the tax code, there are certain income ranges where certain credits start to go away. And generally, it'll be expressed as your credit will be reduced by X number of dollars for every X or Y number of dollars of income you're over the limit. And these are little gotchas that if you're not careful, you will end up owing a lot more than you thought you would. So let's understand this. So there are 2 credit phase outs here. The child credit which is $3,000 per child, phases out but it phases out $50 per 1,000 in income over 150K. So what this means, in this example, we went from 150 to 160. We said $2,200 in income tax, right? But we also have this phase out. So this phase out here is $50 times 2, we have 2 children, times 10. Because we're $10,000, it's per 1,000, so we're going to do 10,000, and we get $1,000. So we know that because we went from 150 to 160, our child credit was reduced. So now we have this additional $1,000 that you get less in credit, so you're going to owe more. But now we have the stimulus. Now in this case, it's a little bit simpler. At 160, it completely phases out. At 150, you get the full amount. So when you do this, it's 1,400 times 4. 5,600. So you now owe, if you thought you were counting on this credit, now you don't get it anymore. Because now you owe $5,600. And this is where people get trapped, is they thought it was only $2,200. They didn't see these other amounts, this 1,000 and this 5,600. So you thought it was this, but what you don't realize is you got bit by this and you got bit by that. $6,600 more in tax that you will have to pay because your credits got cut. This is key and why you need a tax planner. So when I add these up, and add these up, 56, 66, 88. This is an 88% rate. Sorry, my handwriting's sloppy. $8,800 more, that's what you paid. You paid $8,800 more because you sold this stock. And what happens, and what I see a lot of people do, is they think they'll do their own tax planning. You know, they go and they look at these websites, or they'll go like to TurboTax or whatever. And TurboTax does have some good tools. They have a tool called TaxCast that you can use and kind of play with different scenarios. But this is why when you do this stuff, if you're not comfortable doing it on your own, you need to talk to a CPA, talk to a competent professional. You can talk to an enrolled agent as well, and have them run projections for you. Have them look at this stuff. And also, I tell you, take initiative and do it now, because if you don't and you start selling stuff, it may be too late in December. What happens if the market keeps going up and you don't have an opportunity to offset with a loss? This stuff here is key why you need good tax planning, because these kind of phase outs can bite you, and they can bite you really hard, as you see here, because you may have thought, hey, I'm going to get the stimulus credit, and I'm going to get the full $3,000 per child tax credit, and then you end up doing your tax return, or maybe you have a CPA do your return and you don't do any planning before the end of the year, and all these phase outs hit you. And when these hit you, you end up thinking, I'm going to get a big fat refund, realizing, no, I'm going to owe a bunch. This is key. So I cannot stress the importance of proper tax planning. And if you're not doing it, you need to be doing it. please, please, please don't ignore these kind of things. These things can really bite you. So, what are some things that you can do if you're in this situation? Well, max out your 401k. If you're an employee, max out your HSA. If you can do that, if you can add to it, do those things. Do things, if you have a business, are there purchases that you can accelerate? You know, if you need a new computer, don't buy it just to buy it, but buy it because you need it. If you need these things, go ahead and do these things. Do whatever you can to lower your taxes. Work with your CPA, EA, tax professional, and do that. It's so important to your tax, to make sure that you don't run into any of these kind of cliffs. So, if you have any questions, feel free to drop them in the comments. I hope you got a lot of value out of this video. And as always, you know, be sure to like this video, subscribe to my channel for more great content. Have a great day.